When Walmart released its second quarter earnings for fiscal 2027, the numbers seemed to tell two entirely different stories. The official corporate release showcased a massive 28.8% surge in reported GAAP operating income. Management touted a 30% profit growth and raised guidance. But local outlets reported their slowest sales in 6 years, wiping 6% off their valuation. Algorithmic trading bots are programmed to parse top-line revenue beats and raised guidance as immediate automatic buy signals. Institutional capital takes the exact opposite approach. They ignore the headline beats and immediately scan the underlying margin quality. To understand why the market sold off one of the strongest retail earnings reports of the year, we have to look past the press release and audit the raw financial statements. Our objective is to deconstruct exactly how Walmart generated that $9.38 billion operating income surge. A raw profit figure blends organic retail execution with macroeconomic noise. We need to separate the two. The metric we use for this is margin quality. High-quality margins come from operational efficiencies that a company can execute and repeat reliably, quarter after quarter, year after year. Institutional investors actively hunt for equities displaying low-quality margins because they represent a temporary mispricing in the stock. True corporate health is never found in the consolidated GAAP headlines. It is always buried in the footnotes and cash flow statements. Walmart reported a highly impressive 5.9% growth in consolidated total revenue, bringing in $187.9 billion for the quarter. But to gauge actual domestic consumer demand, analysts isolate U.S. comparable store sales, commonly known as comps. This bar chart breaks down Walmart's 2.6% U.S. comp, driven by a 1.5% increase in transaction volume and a 1.1% increase in average ticket size. But tucked into the supplementary data is a massive 510 basis point contribution from e-commerce. Stripping out that digital growth reveals a strict mathematical reality. Core physical store comps actually went negative for the quarter. That 1.1% increase in average ticket size is highly revealing when weighed against current macroeconomic inflation. Because inflation outpaced 1.1% during this period, this weak ticket growth indicates the retailer has lost pricing power and cannot fully pass costs on to consumers. The company reported a 23% surge in global e-commerce, which effectively served as a smokescreen for this domestic physical retail weakness. The 5.9% total revenue beat successfully masked the slowest pace of core physical U.S. retail demand the company has seen in 6 years. With physical demand slowing, we have to look at the gross margin expansion to understand what actually drove the 28.8% operating income beat. This waterfall chart illustrates the Q2 gross profit rate, expanding by a massive 96 basis points to 25.4%. Management's footnotes reveal the primary source, a line item labeled tariff refunds. This accounting artifact generated nearly $1.8 billion in excess gross profit. A tariff refund is a one-time macroeconomic windfall. It is a government rebate, not an organic improvement in operational execution. The metrics driving these refunds are dictated by the physical reality of international trade logistics and bulk shipping container volumes. Geopolitical trade policies and border regulations can create sudden cash infusions that temporarily distort local quarterly earnings reports. Reaping a sudden cash injection from a trade rebate is entirely different from doing the slow, difficult work of expanding margins through organic growth. Corporate narratives often attempt to blend these macroeconomic windfalls into their broader stories of regular operational success. The impressive Q2 gross margin beat is a low-quality accounting illusion, subsidized entirely by a one-time external event. To contrast that temporary margin expansion, we need to look at the reality of the company's actual operating expenses. Large-scale retail operations often face structural deleverage, where the baseline costs of running the business grow faster than the revenue it generates. This stacked area chart shows operating expenses as a percentage of net sales, visualizing an adjusted rate that climbs 40 basis points to reach 21.4%. The earnings presentation identifies the first major driver of this deleverage as higher self-insured general liability claims. The second driver stems directly from capital allocation, higher depreciation expenses resulting from recent capital investments. The final layer is driven by human capital, specifically increased associate healthcare costs and broader medical inflation. These specific expenses represent sticky, structural, and permanent burdens on the profit and loss statement. Management utilized transient macroeconomic cash to temporarily mask fundamental ongoing deterioration in their core operational costs. We can see exactly how these dynamics will play out in the second half of the year by examining the forward guidance block. The headline stated that management raised their full-year fiscal 2027 outlook, but this merely absorbs the backward-looking Q2 tariff cash, rather than projecting future outperformance. We see this clearly by looking at the specific Q3 guidance, where the 17.4% adjusted operating income growth from Q2 drops to a projected growth rate of only 2% to 4%. This represents a steep, immediate deceleration in operational efficiency. The CFO explicitly warned of an additional 100 basis point structural headwind caused by a timing shift in Flipkart's Big Billion Days event. Stripped of the Q2 tariff inclusion, the forward guidance signals a severe contraction in operational momentum. This forensic audit perfectly explains the market's initial reaction, but we still need to examine how management intends to use that Q2 tariff windfall. The CFO stated that the remaining tariff funds will be deployed entirely into price investments during the second half of the year. In retail accounting, a price investment is a required markdown or an aggressive discount designed specifically to stimulate lagging consumer demand. This creates a compounding pressure for Q3. The company will lack the Q2 tariff subsidy, but will fully retain the structural cost burdens. Institutional models accurately forecasted this future cash flow pressure, which directly prompted the initial 6% sell-off. Identifying decelerating organic comps hidden beneath corporate growth metrics is a requirement for accurate financial analysis. A headline beat and raise is financially irrelevant to investors when peak margins rely on one-time accounting events and underlying organic demand is structurally decaying.